Hi investors! Today we're going to discuss about the new announcement by MSCI on the free float assessment of Indonesian stocks. On January 28, the market crashed at the open. The stock market dropped close to 9% and underwent a 30-minute trading suspension and closed at minus 7.4%. So, what happened? MSCI took everyone by surprise. On the early morning of January 28, MSCI announced the result of consultation on free float assessment of Indonesian securities. Let's dive into the details. MSCI announced that 1. They will freeze all share adjustment factors. 2. No new additions to the MSCI Standard Index and Small Cap Index. And 3. No upgrades of stocks within the MSCI indexes. They announced that this is a temporary treatment effective immediately. MSCI also announced that they want transparency, and if situation doesn't improve, it might lower Indonesia's weight within the MSCI Emerging Market Index and furthermore, reclassify Indonesia's market status from emerging market to frontier market. Our interpretation is as follows. This is a classic panic selling. Investors don't like uncertainties. That being said, investors were selling Indonesian stocks first and recalibrating their investment pieces. Secondly, they highlighted transparency as their main objective behind these temporary measures. They mentioned transparency 4 times in their announcement. However, they did not mention what adjustments that they will make at this point. Lastly, our question was whether MSCI could have done this without the consent from the regulators and SROs. However, in the announcement, MSCI mentioned that they will, quote, continue to engage with authorities, unquote, which is a clear indication that everyone is aligned on this objective. This, we think, is a structural change. However, this is a bad timing. Market is highly liquid, and last year, most markets booked amazing performances. However, this year, Indonesia is the only country that is exhibiting negative returns. Let's take a look at the inclusion criteria for MSCI indexes. We have 3 criteria for a stock to be included into the MSCI index, namely free float adjusted market cap, and liquidity. The most important factor that we need to discuss here is the free float. Basically, the general minimum free float requirement for the MSCI inclusion is 15%. However, there are some exceptions to the large cap inclusion, but we would not go too deep into that discussion. So every company reveals their free float in their financial reports. In this case, the free float is 44.8%. According to the IDX, the minimum requirement for a stock to be listed is 7.5% free float. And for MSCI inclusion, the minimum threshold is set at 15%. However, MSCI wants to dissect this free float and calculate the real free float. How does MSCI calculate the free float data for a stock? Well, MSCI categorizes investors and classifies them as free float or non-free float. So if you have banks, companies, your own employees, governments, etc. as shareholders, MSCI considers them non-free float. On the other hand, if you have individuals, hedge funds, insurance companies, and so forth, MSCI considers them free float. However, they do make some adjustments based on the data provided by KCI. For instance, not all companies are classified as non-free float. They selectively look into the companies and make adjustments accordingly. That goes the same with individuals. However, according to market talks, MSCI is reviewing to carve out all the shareholdings by companies from the free float calculation. We suspect that this is in part due to abnormal valuations of companies listed on the IDX. As we can see in this illustration, some companies are trading at triple-digit PE. And because of this new announcement by MSCI, even companies trading at reasonable valuations are negatively impacted. The collateral damage is too big in our view. We want to highlight a company listed in the US. Tesla is currently trading at 287 times PE. During liquid markets, we think it's not abnormal for valuations to overshoot. We can't simply judge that companies are overvalued simply because they're trading outside of the historical average. The big question is whether MSCI will downgrade Indonesia's market status from emerging markets to frontier markets. We see very low probability of the downgrade being realized in the near future. However, if the downgrade were to materialize, the impact could be devastating. We could expect to see significant outflow of funds. This will cause chaos to the nation's currency and structurally disrupt the corporate funding activities. So how should investors react to this news? Well, we think market will remain choppy for the time being. We believe investors will need time to recalibrate and digest the new rules set by the MSCI. However, we want to highlight that nothing has changed. The market is still liquid and it will continue to remain liquid. Moreover, this new development has no impact on corporate fundamentals. That being said, we think it's a perfect time to adjust your investment portfolio. So the moral of the story goes like this. It would have been great if MSCI decided to smoothen the new regulation. However, what's happened has happened. This event should serve as a good lesson that asset diversification is important. Also, we think market will remain on a roller coaster ride until we see some clarity on the new free float adjustment rule. It's also worth mentioning that we see low probability of MSCI downgrading Indonesia's market status to frontier markets. Last but not least, we think it's a good opportunity to take interest in stocks that have strong fundamentals and are less impacted by the MSCI play. If you have enjoyed the content, please like and subscribe and leave comments below. Thank you.